We can all expect to pay more for gas in the coming months. Hello, and thanks for checking out this week's fastest 4 minutes in finance. I'm Scott Inman. Well, anytime we mention OPEC, the news is likely not very good. OPEC stands for the Organization of the Petroleum Exporting Countries, and it's pretty much led by Saudi Arabia. That organization announced earlier this week that it will be massively cutting oil production, which is expected to send gas prices soaring again, just as we seem to be getting inflation under control. The price of crude oil shot up more than $4 per barrel in the 2 days following that announcement. Tom Clausa, the global head of energy analysis at a research firm, told Fox Business that every dollar the price of crude rises means a production cost of about 2.4 cents more per gallon. That creates almost a certainty that gas prices will be rising. And they had been trending down. Take a look at this inflation dashboard chart from LPL Research. On the seventh line, you'll see the average AAA retail regular gasoline price per gallon for every month going back to June of last year. Gas prices are extremely volatile, but you can see prices have dropped from $4.92 per gallon to $3.45 per gallon over the past 10 months. Right now, right below that line is the Consumer Price Index. During that same time frame, we've gone from 8.93% year-over-year inflation to 5.99%. The dashboard is also color-coded, and you can see that in 7 of the 10 categories measured, we are going in the right direction when it comes to inflation. Gas prices, though, was one of those 10, and it won't likely be any more. So the question is, how big of an impact will higher gas prices be on inflation, on increasing the risk of recession, and on the Fed's next decision on interest rates? Well, higher oil prices will affect the inflation numbers, no doubt. But as LPL Research points out, the modern domestic economy is less reliant on crude oil, and the pass-through effects from higher energy prices are not as pronounced today as in previous decades. And you could even argue that OPEC's decision to cut oil production was in advance of an expectation of slower demand brought on by a recession. Manufacturing activity last month fell to its lowest level since May 2020. Employment shrunk for the second straight month as firms continue to cut workers in response to weaker demand. Economic data is suggesting that a U.S. recession is near. LPL Research believes we should prepare for a weaker job market, higher unemployment, and cooling wage growth in the coming months. Now, if all that happens, the Federal Reserve should be convinced to take its foot off the gas on raising interest rates. Bottom line for your personal economy here is be prepared for higher gas prices, especially if you're planning a summer vacation. Make sure you've beefed up your emergency fund to be prepared for a potential job loss. The recession may be coming, but it should be short-lived. So we should expect more market volatility in the near term. Stay invested for the long term, though, and stick to your plan. Thanks for watching.